All right. Hi, everybody, and welcome to tonight's apartment association meeting on this cold night and maybe snowy for some of you, maybe on the east side into the south. So once again, I'm Mike Cottrell, and appreciate everybody joining us tonight. We got a very interesting evening tonight to talk about financing and a little bit of underwriting, et cetera, in the current environment that we're in. We've got a couple nice guests, and we got a couple board members, Letitia and Jasmine, who will be moderating and introducing our speakers. Additionally, I want to right away thank our Advantage sponsor members, Gersten, Barada, Always Towing, and the Equitable Bank for their great support for 2021. I also want to kind of just highlight a couple things that have taken place here recently. We had an excellent boot camp over the weekend again with a really nice number of participants and a really good Q&A that took place in the afternoon from Tristan Pettit, and the Q&A in the afternoon as well. So additionally, we have a lot going on. Legislative Day last week was very interesting, and if you didn't participate in that, you might want to check some of the postings out there under WAA and AASEW as far as Legislative Day and some of the comments and some of the thoughts and the things that were shared and passed on. Additionally, with the moratorium, everybody is always wondering about the moratorium, and I won't go into a bunch on evictions, etc., but obviously that moratorium is in place until the end of March. The new, round of funds should be available. The counties and the cities have their allocations. They don't have the funds yet, but we do know that Milwaukee County, the CDC, SDC, and community advocates will be, the ones, monitoring those funds, and/or the process goes through them to receive those funds. We will have more with that as well, or on that. We anticipate a lunch and learn, something of that nature, for our members upcoming very shortly, with a couple guests from those areas as well, with that process to help you as a landlord understand the process to get those funds, because now you can help and participate with that with your tenants and make that transition or that application easier. So that being said, that's a lot of stuff just at a high level going on. I would also encourage you to reach out to us if there's things, topics you would like us to cover, additional things that you would like to see under our resources tab on our website. You should be logging in with your user ID, your member ID, and you'll be able to get to that resources tab. We have a lot of links, a lot of things on there to help you as a landlord from an educational standpoint or a process standpoint. So I'm gonna just switch slides here real quick. All righty, and part of the evening as well is with our business partners. We're trying to make sure we take time to highlight some of our business partners every month in our meetings, since we don't have that face-to-face opportunity. Tonight's business partner spotlight. Our first guest is Yanni with Tri-City National Bank. He actually is one of our speakers and guest speakers this evening. So Yanni, if you want to unmute yourself and kind of tell us a little bit about Tri-City.
Hey, Mike, thanks for having me. I'm glad to be here. So my name is Yanni Bombarakos. I'm with Tri-City National Bank. Tri-City, we're a local community lender based out of Oak Creek, Wisconsin, with 34 branches expanding across southeastern Wisconsin. Our geographical footprint goes as far north as Menominee Falls, as far west as Waukesha, and as far south as the border to Illinois. We do deals all across the state of Wisconsin, primarily in southeastern Wisconsin. Legal lending limit of 29 million, call it house limit of 20 million. So Tri-City National Bank. Thank you.
Alrighty, thanks, Yanni. And actually, I'm just going to cover the Equitable Bank here real quick. I think for the most part, a lot of you have had the opportunity to hear me speak over all the years and hear a little bit about the Equitable Bank. But obviously, we're a great little diamond in the rough institution based out of Wauwatosa. Been around for over 90 plus years as a community bank with our charter. Been lending to folks in the community and taking care of community needs for a long time. So specifically as it relates to the multifamily industry, as many of you know, we love this industry. It's our bread and butter day to day. I made a mission of my own since the last recession in 2009 to really be an expert in this space, and we're out there lending on new deals, refis, cash out, etc. Especially in the multifamily stuff, 5 units or more specifically. That's the area that my expertise is in. I do have some other some lenders from a residential 1 to 4 standpoint that we can help out with as well if they fit what we're kind of looking for from a 1 to 4 family standpoint. So really appreciate everybody's support and the relationships that I've made out there over all the years of doing this. So really appreciate it. So that being said, I'm really excited tonight to have Jasmine and Leticia kind of moderate things. I'm going to turn things over to Leticia and Jasmine at this point. I will stop sharing my screen and kind of turn the mic over to Jasmine and Leticia. Thank you, everybody.
Good evening, everyone. My name is Leticia Schwengel, and I am one of your board members. Really excited to bring a conversation to all of you in regards to the financing economic market that our different lenders are currently experiencing. With everything that's happening right now, I think it's really important for our members to be able to take advantage of the low interest rate market that we're currently experiencing. And therefore, we wanted to do somewhat of a Q&A, so a little bit different than in the past, to kind of just pose some questions to our presenters on what we think might be going through the mind of our members. And maybe it's questions that sometimes you don't think about asking, or you're potentially considering either acquiring a new piece of property or refinancing some of your existing properties, and you wonder what the process looked like, right? It has certainly changed from 2019. As you guys all recall, the first quarter of 2020 was very exciting. It was, moving at a very rapid pace. And then we kind of just came to a stop at the mid to end of March. And so a lot of lenders did kind of stop what they were doing in that, last 3 quarters of 2020. But it looks like things are starting to turn around. Now, you'll hear from some of our speakers that their specific companies did not stop lending. They were lending as usual, but with a little bit of more caution, right? So we just want to make sure that you guys understand all of that. Jasmine, I'll let you introduce yourself.
Hi, everyone. I'm Jasmine, and I, as well, am a board member along with Leticia, and really excited to answer any questions you may have. Every, institution has something that they're really good at or something that they specialize in. So it's really nice to get a variety of, perspectives on what a certain bank is looking for. Generally, they all are looking for the same thing, but it's nice to kind of see, what everybody is going through. So definitely, if we're using acronyms that, you're not too familiar with, please jump on the chat, let us know. We're going to be continuously looking at that so that we can ensure that we answer everyone's question. Don't be shy. And I'm really excited because even though, it's a difficult market to lend in right now, it's definitely still happening. So get those questions answered. And like Leticia said, taking advantage of those lower rates are key. So So definitely looking forward to learning more along with everyone. Thank you.
All right, perfect. So I will just say the names and the titles of the 3 individuals that are participating today as our panelists, and we will allow them the opportunity to, or give them the opportunity, I apologize, to share more about what they do on a day-to-day basis. So we have Brett Johnson, who is with the Equitable Bank, and he is a current commercial lead underwriter, I apologize. And so he's definitely someone that we should ask a lot of questions to, right? Us as lenders typically rely on underwriters to either identify certain things that maybe we missed or we didn't see. And there really are, you know, kind of that compliance side of the bank that ensures that some of the risks that we're taking make sense for our institutions. And then we have Yanni. Yanni, you're probably going to hate me for the way I'm going to pronounce your last name, but Bambarakos, potentially. And he's one of the business development officers at Tri-City Bank. And then we have Garnett McLeod, a commercial lender with Kohler Credit Union. So why don't we go ahead and start with Garnett?
Good evening, everyone. My name is Garnett McLeod. I'm a business relationship officer with Kohler Credit Union. My office is located in Mequon. However, I cover Milwaukee, Waukesha, Washington, and Ozaukee County. We specialize in financing multifamily unit properties. Kohler Credit Union is about 3 things: building relationships, strengthening communities, and fulfilling dreams. Over 90% of every dollar the credit union makes actually goes back to our members in the form of lower rates and lower fees, because we are a not-for-profit organization. Given the historical refinancing, or given the historical rates, refinancing or purchasing may be right for you. If you find this information beneficial, my information is in the monthly newsletter. Thank you.
Oh, you're on mute, Leticia.
Brett?
All right. And I have some slides I'm going to share. So I saw that there were some questions ahead of time kind of on what financial package you should provide when you're looking to either refinance or apply for a new loan. So I'm just going to. All right, so I'll start here. So this is kind of the basic structure and cash flow that we're looking for. So
Hey, Brett. Hey,
Brett.
Brett, this is Mike. Leticia wanted you to do your bio to open,
Oh,
please.
sure, my bad.
Okay.
That's fine. Yeah, so I'm a commercial credit underwriter here at the Equitable Bank. So I work pretty closely with Mike on a day-to-day basis, underwriting a lot of the deals that he brings in, along with other commercial loan officers that we have at the bank. I also work pretty closely with the chief credit officer at the bank, doing some more macro level stuff with the assets of the bank. So that's my main duties on a day-to-day. So.
And Yanni, why don't we go ahead and let you introduce yourself?
Hi guys, once again, Yanni Bambarakos from Tri-City National Bank. I'm a business development officer, commercial lender at Tri-City. They go hand in hand. From the day-to-day, I'm hitting the ground running, looking for deals here and there. Tri-City, though, we specialize in multifamily financing right now. Industrial, owner-occupied real estate we excel at. But we're actively looking for deals in the greater southeastern Wisconsin range. Last year in 2020, that didn't stop Tri-City from lending. Biggest deal we did was $20 million. The smallest deal we did was $2,000. So we do the full gamut of commercial banking for sure. Thank you.
All right, perfect. So let's go ahead and start the conversation with how COVID has impacted your organizations when it comes to new money requests that are coming in for clients that are either looking to finance a new piece of property or looking to refinance. Are you guys actively lending? Can you tell us a little bit more about that? Garnett, why don't we go ahead and start with you?
Absolutely, thank you. Since the pandemic started, obviously in March through, I want to say June, we were a little slow, doing only mainly PPP. But with the interest rates lower, a lot of our members and new members started taking advantage of the lower rates. So right now, I would say it's about 60 to 40%, 60% being refinancing, and then 40% being in new purchases. So that's really, we've been lending ever since, and we continue to lend.
Okay. Anything specific that your organization looks for, or questions that you guys should prepare our members for when it comes to, you know, occupancy, rent collections? I know that that's a big topic of discussion with landlords in today's day and age.
Yeah, the one question that we do ask right now is how has COVID impacted, you know, your rent, so to speak? Meaning, you know, like, do you have to give a certain percentage, you know, like, or is there a certain percentage of people that aren't paying? Basically, we asked that question just to see, because a lot of a lot of people who are trying to refinance or purchasing, those are the questions that they need to obviously understand. Things that we look for, you know, typically, you know, we look at the person's character. You know, depending on if it's a refinance or a purchase, 75% LTV for a refi, and then up to 80% LTV for a purchase is what we typically like to see.
Okay. Yanni, what about Tri-City? How are things there when it comes to lending in a COVID world?
Absolutely. So Tri-City, we're dedicated to lending in all economic conditions. Our faucet or our tap is still on, in a sense. We're still actually pursuing deals across the board, whether it's multifamily financing, industrial, owner occupied. We're even getting retail strip centers and things like that done at the moment. So I'd say it's business as normal. Our LTVs are a little bit more conservative. We're 75% generally across the board. So a little bit more in skin in the game in a sense, but we're looking at overall character, strength of guarantor, things like that. Just this is all senior. So.
Okay. And then Brett, as an underwriter, you know, what are some specific things that your bankers are looking for to ensure that it's something that meets, you know, that the parameters that Equitable Bank is interested in?
Yeah, so the two main questions that we ask pertaining to COVID are, how has COVID negatively affected your tenant's ability to pay? So we'll pull people and ask, have you seen an increase in late payments or partial payments and missed payments and things like that? And then the second main question we'll ask is, has it affected your ability to find new tenants? Have you had a longer waiting period of finding people? Have you seen a higher vacancy than usual? And I would say, for the most part, the greater Milwaukee area, at least from the borrowers that we have, but we haven't seen a significant or long-lasting effect. We have had a few existing clients that have had maybe a little harder time finding new tenants, or had a few that had a few months of late payments and things like that. So, but other than that, it's been pretty much business as usual with underwriting for apartment loans, multifamily loans.
I think one thing that I can kind of share with you guys too is that although we do understand that there's going to be a small percentage of tenants that may not be able to pay the rents for, you know, X number of factors, one additional question that we pose at US Bank is, what kind of plan and strategy do you have in place to collect that back rent, right? Mm-hmm. Is there some kind of payment plan that you have with your tenants? Because that shows us that you're actively communicating with your tenants, that you do have a plan in place, and that, you know, over the next X amount of weeks or months, you expect to recover all of that income that was potentially late. So that's just something that we also, you know, ask our borrowers. The other thing that I wanted to ask, you know, I heard cash out options, I heard purchases, I heard refinance. It is definitely a refinance market right now with interest rates being as low as they are. Can you tell us a little bit about what our clients can expect when it comes to our members can expect when it comes to the difference between a cash out? So, you know, you buy a property, it's free and clear. Now you're looking to potentially, you know, throw a mortgage on that property. What are your parameters there? You know, does it have to be stabilized? Do you want tenants? Do you lend to an unoccupied building? For new acquisitions, are you seeing appraisals come at, you know, what's expected as far as the buyers? We do see that prices are escalating significantly in the real estate industry, especially for investment properties. We see a lot of out-of-state buyers coming into the Milwaukee market and pay relatively high prices for, you know, city-owned or city properties that maybe won't appraise. So just want to see what your input is on new purchases and if you're running into any issues there. Yanni, why don't you go ahead and start with this one?
Absolutely. So I'd say on the appraisal standpoint, on purchasing properties, you're starting to see cap rates obviously shrink into the low sixes and even fives at times for purchases and transactions. That's probably one of the biggest worries that we have at Tri-City at times is whether or not it will appraise out. We're seeing just today I had a couple of properties on my desk and they were selling at five caps. Makes it a little bit difficult at times to try to get a deal done, but we're getting it done. Generally, with transactions like that, we're requiring a little bit more cash into the deal or maybe a seller's second or something along those lines to help offset our LTV there. But on refinances, where we're going strong with them, I'd probably say this year, probably every other transaction is probably a refinance at loan committee, personal deals that I'm working on here. So refinancing is obviously a hot button topic. We're lending to just about anything though. Maybe not unoccupied buildings or vacant buildings. But a lot of the times too, we understand that if there's a strong global and there's pro forma rents or future rents to come, we're willing to underwrite to that at times as well. So.
Okay. Garnett, what about yourself?
Yeah, so the way we do it here at Kohler, so what we do is we'll underwrite the deal as is, meaning, we look to see if you have tenants. If you're trying to get a cash out, so to speak, a cash out refi, we will look to see, obviously, how well does a deal cash flow as is, with tenants, whether it's without tenants, and then we'll lend up to 75% LTV. So basically, we'll ask you, how much are you trying to get? So let's say, I'm just going to use a round numbers. $1 million is what the property is going to appraise at, hopefully. So the maximum we'll lend is $750,000. If you owe $500, we can go up to that $750. As long as that property appraises, you are good to go. As far as appraisal coming in, I've only had one deal that did not appraise, but everything has been obviously just through the roof, just in this market. With new purchases, we're not seeing, we're not doing a lot of, I would say, like cash outs on new purchases. One familiar, we're just not familiar with that new member, so to speak. We like to get to know the member, have like a history. So right now it's just pretty much a straight purchase, no cash out on that end.
Okay. Fred, anything you want to add to that?
Yeah, I will say that very rarely have we seen a appraisal not come back at the purchase price. And I know Yanni kind of alluded to it. Cap rates are still pretty low from what they have been for the last few years. So, and I know we'll look at a cash out deal kind of similarly where an as is, like who's in what kind of tenants are there now, what's the cash flow with the current tenants, as opposed to like a perspective if the building's half empty or something like that. So, and I don't know.
Oh, sorry, go ahead.
No, I was just saying, I don't know if Mike has anything to add about any of the terms. That's more his expertise.
That I'll sit and listen, but all those things are right in line.
Okay. I was going to add that, all of you guys are bringing up a really good point, right? And as I'm thinking about our members that are on the call today, I think about, loan to value and how important that is, right? Garnett, you keep saying LTV, right? So just so everyone knows, loan to value. That just means, what's the amount of debt to the value of your building. And so for those of you, if you think about it and you have a property that you've had for 5-10 years that has had the ability to build equity, you now have the opportunity to potentially reach out to one of these guys, refinance that property, and maybe just sit with a little bit of cash on the side to get ready for what I think we're thinking in the next, 12, 24 months, we might see a surplus of properties become available based on how some landlords can handle this pandemic. So it could be a good strategy to be able to, again, build some reserve capital for potential acquisitions. So something to keep in mind, okay? Now let's talk a little bit about what it is that borrowers can expect to have to bring to each one of you, right? So if they're looking to do really any kind of transaction, I think it's pretty much across the board, whether it's a refinance or a purchase, typically we're all requiring the same things, right? So can you walk us through what our members should be putting together when it comes to having a full financial package ready to go? Do you guys work on pre-approvals, or is that something that maybe the commercial side doesn't really do like the residential, mortgage group typically does? Garnett, how do you guys handle that at Kohler Credit Union?
Absolutely. So we ask for 3 years of your business tax returns and 3 years of your personal tax return. We do ask for a current PFS, which is a personal financial statement. I ask for a personal bio. It just gets to know the member. Obviously, your years of history doing this. It just helps to tell the story to our loan committee. We do require that you do have an offer to purchase, a signed offer to purchase. We will not move forward unless we have that in writing if you're doing a new purchase. And then we obviously articles of organization and operating agreement, and then a debt schedule, which is just basically any other properties you own, the balances, things of that nature. And then we ask one final question, which is a 12-month forward outlook. So any anticipated capital expenditures for the property, things of that nature, and that's pretty much it. And then a rent roll. Like obviously, what are the tenants in the property? What they're paying? Is it month to month? Simple things that you guys should already have.
Okay, so it's interesting that you mentioned 3 years. I'm sure maybe some of the others would say more like 2 years, depending on the size of the loan request. Yanni, is that pretty similar to what you guys are looking for at Tri-City?
Yeah, for the most part, I'd say we were able to get deals done with 2 years of financial information. 3 years helps to show a trend, obviously. So more the merrier at times, but otherwise, same thing as Garnett here. Rent rolls, perform on the property, lease maturities, things like that, debt schedules, detailing balances, payments, things like that, interest rates. So it's pretty universal, I believe, across the board.
And then Brett, for you, this is probably really important, right? Because you like to have as clean of a package as possible, so that it makes your job a little bit easier. But what do you like to see to make sure that, oftentimes borrowers will give you certain things, and then we as bankers go back and ask for more because our underwriters want more. And so it becomes a little tedious for our members and borrowers to have to always constantly give us more and more information. So as an underwriter, what's your perspective on that?
Yeah, so I guess just kind of piggy banking off Yanni and Garnett. One, I would say the most common follow-up question, like you said, to kind of reduce the back and forth when you're looking to apply for either a refinance, a cash out, or purchasing a property, is to keep in mind if you had any big events on your existing properties, if you had something that significantly reduced the cash flow on a property from 1 year, or significantly increased it, kind of having those answers or things ahead of time for the last few years. Because I would say a lot of people are very good about getting information on the property at focus that's being financed, but they'll kind of forget their existing portfolio of what they have. Say they had a property that for some reason they had to replace a roof a year ago, and that affects their global cash flow significantly. So that's something that it's a pretty common question that I'll come back with, where if you think about these things when you're applying and you have these questions ready, you can really cut down on the turnaround time for an approval.
Yeah, perfect. Well, I'll hand it over to Jasmine in just a little bit here, because we're going to get to kind of everything you've said, everything everyone has said is really important, but how do I, as a potential buyer, right? How do I know that the property that I'm looking to invest in makes sense? Is this a good investment for me? And is this an investment that if I take to my banker, that they're going to feel comfortable lending on? So what we want to teach our members is just how to understand how someone like Brett thinks, right? Like, how does an underwriter think? How can I bring something to the table that's attractive enough that my bank is going to go ahead and move forward with this type of financing? So we want to make sure that we educate our members on this and make it a little bit easier for them to be able to, go back to their tax returns maybe later today or sometime during the week and say, okay, well, what are some of my strongest properties? Do I have the ability to refinance these properties today? Am I able to maybe pull some cash out for some additional investments I'm looking to do? And so that's kind of where the cash flow analysis part takes place, right? And you mentioned global. And I think it's important for our members to understand that, you know, we do cash flow the asset, right? We want to see what the asset is doing, but then we also want to look at them holistically. So I'll turn it over to Jasmine to kind of hand them over the financial discussion.
Thank you, Leticia. And I also kind of want to piggyback off of you as well to kind of think as well about prepayment penalties. So, I mean, you know, we have a big range of, you know, members here. Some are just starting out. Maybe they bought their first property under their, you know, like a 4-unit or a duplex under their personal name. And, you know, personal residential loans don't have prepayment penalties. So even though it's such a great time to refinance, we also have to take into account that number. You know, what is that going to cost me to refinance? Or, you know, are we going to have to, would my bank waive it? Or, you know, what, you know, have you guys had experience with that, Yanni and Garrett? You know, you want to move forward with the deal, but then the prepayment comes in and then it kind of kills everything.
At times that is a conversation for sure. I would say prepayment penalties. One thing that we've been noticing lately that's been helping ease investors' concerns about prepayments and whatnot. We'll put call it a clause in there where the prepayment will only be charged if you say refinancing midterm or something like that. So if you're looking to sell the property or something like that in the middle of the term or pay us off completely, we're okay with it. So.
Okay, good. And that's an important question for our members to ask is, you know, what is my prepayment penalty, and sort of understand what that is and, you know, how that affects the loan. So I kind of wanted to go back to you, Brett, and just, I know in the beginning you kind of had some really nice slides. So I just really want to see if you can explain to the members, you know, how can they run a quick, you know, cash flow on a property that they're looking to buy, and what are some good things to kind of, you know, the 3 things to look at, and how can they do that pretty fast and efficiently?
So a good way to do a quick cash flow when you're looking at a property is getting the current rent roll for it. Kind of what I like to do, like when Mike has a deal and he said, hey, if we do a quick cash flow on this, is then kind of calculate what the average rent is per unit, and I'll times that by how many units there are. And then from there, I'll have a gross rental income. And then we at the Equitable Bank basically do a 5% vacancy. So I'll times that by 0.95 to get an effective gross income. And then a conservative way to see if it's going to cash flow is then you can just divide that by 2. So that basically just assumes that your operating expenses will be roughly half of what your income is. And I would say typically when you have a property, it's probably closer to the 42% to 45% range. So just dividing it by 2 is a good way to quickly do that on a conservative basis. And then from there, you can kind of just either go online, or if you have a finance calculator, you can calculate what your monthly payment would be based on the loan amount you're looking for. And then from there, you can do an annual debt service. And then typically, what you'll do there is you'll divide what you have left after you divide by 2 by the annual debt service. And if you're above, you know, 1.2, 1.3, you're probably looking at a property where you can be profitable. So that's a real high level, quick way to kind of, if you're looking at a property, to see if it will cash flow.
And debt service coverage ratio for those members that are on the call today just means, you know, for every $1 of debt, you know, the property is bringing in $1.30, right, Brett? That's essentially what that means. So we want to make sure that you're making money on the dollar. Sorry, Jasmine, go ahead.
Oh, no, perfectly great. I did kind of want to go back to one of the questions in the chat and address it really quickly. It says, what are the minimum loan amounts? Garrett mentioned 1 million, but do you go down to like 100,000 or 50,000? Do you guys have a limit on the amount or a minimum that you will finance for real estate transaction?
I haven't seen any minimum. The $1 million I used was an example of LTV. my LTV, loan to value LTV estimate. As far as minimums, last year I did a deal for 60,000. So, I wouldn't say that there's a specific minimum. So no.
And Brett,
there
have you
wouldn't be-
seen anything? Oh, go ahead, Yanni. Sorry.
There isn't any minimums, I would say, at Tri-City either. We see the full gamut of lending at a loan that's repeatedly stuff. So.
Yeah, and I think it's really important for our members to understand that there's no too small of an investor, right? So if you have a one single family investment property, or you have a multitude of multifamily portfolio, I mean, it's the same process for everyone. And we appreciate, I think, I can speak for all the bankers on the call today, we appreciate every business regardless of the size of the deal.
Okay, my next question that I have, we can go to Garnett for this one. Is the cash out refinance an option at your institution? And then is there a holding period that's required for a property LTV, versus purchase price? Is there, a certain type of time limit that the property needs to be held for?
Okay, what do you mean by the second question?
So is there a certain amount of time where the investor has to have the property under their name to be able to do a cash out refinance?
No. For instance, so let's say that, like someone's bringing a brand new deal to Kohler Credit Union and they want to refinance and do a cash out. Our requirement would be at that point is as long as the appraisal is 75% loan to value, you can do that cash out.
Okay. So if they only had the property a year, that's fine.
Yep.
Okay. Great.
And then what was your first question? You had a first question to that.
I think that was it. I'm sorry if I confused you, but that was pretty much the question.
Hey, Jasmine, this is Mike. I think what you're kind of referencing is from a bank perspective and a bank policy standpoint, is there a stabilization period that is in place typically when somebody makes a new purchase, and I'm just going to use a $100,000 duplex as a good example, and now you've held it for 12 months or 16 months. Is that property now stabilized? It has increased value by appreciation, and then also based on what's going on in the industry and the market, and the value has increased. So now you have an appraisal that would come in greater. Is that now an opportunity that maybe they could re-leverage that property, get some cash out, look to do another transaction? So I think stabilization is kind of the what you're looking for there. What are banks doing, I believe.
Yes. Yeah, that's exactly where we wanted the question to go. I know, for example, at US Bank, if you buy a property for $50,000 off market or on a wholesale basis, which I think a lot of members often, participate in those types of transactions, but the property is really worth, $100 grand. You come to us, you paid 50, it's worth 100. You're looking for, 75 to 80% loan to value, so 75,000 to 80,000. It's really hard for us to justify giving you that additional, $30,000, $35,000 when you only paid $50,000 for the property. So for us, it's a little bit differently than with Kohler, right? So Kohler definitely has that advantage that it's based on the loan to value, as long as the cash flow probably supports it. And some other lenders are a little bit more restrictive on how long you have to hold the property. Okay.
Does anybody else want to jump in on that, Yanni, or?
Yeah, I would say that Tri-City, we're, call it open to cash outs. We're not doing many of them, call it on single family, duplexes, triplexes, four families. We just don't lend them much on those. On bigger properties, things like that, at times we're willing to extend out up to 75% loan to value, depending on when you purchased it. If you purchase a multifamily free, like a 5-family, for example, free and clear a month ago, and it's fully occupied, this, that, the other, and you wanted some cash out for improvements on the property or something like that, more than likely we'd be willing to entertain to look at it into deeper discussions for sure. But we take it by a case-by-case basis, I would say, for sure. Another big thing with Tri-City and cash outs or deals in general, I don't know if I mentioned this before, but we don't require appraisals all the time. So if our loan is under 500,000, we can do something called an internal evaluation, which saves you a cost for an appraisal is about $500 versus doing a full appraisal. So it's one of our advantages, I think.
Awesome, thank you. And then I kind of wanted to touch on, I guess, fees or, costs that the borrower can expect with financing. How do you guys typically handle, the fees and the costs for, doing a commercial loan?
So at Kohler, we have a doc fee, and that can vary based on the size of the deal. We have an appraisal fee, which is whatever the appraisal costs. There's a flood fee, which is very small, and then a recording fee, and then title and insurance. All in, it's honestly it varies from $3,000 to $5,000.
Okay.
Yanni, what about Tri-City?
Absolutely. Garnet, do you have originations fees? I'm just curious, quick.
No.
No. All right. So at Tri-City, we do have an origination fee. Generally, it's call it 25 basis points generally off the size of the loan. But we do have our typical appraisal or evaluation fees generally at cost, are always at cost. And we do have a doc prep or an administration fee that we do as well charge. That ranges per size of transaction as well. But it's hard to call it a dart on the dartboard with fees associated with commercial loans, since they do vary across the board depending on asset type.
Thank you.
Title and insurance, obviously.
Right, all those third-party fees. So, Leticia, do you want to kind of check out some of the questions on the chat here and see,
Yep, absolutely. Before we move on to that, you just mentioned the third-party costs, right? And I think that's really important for our members to understand. Oftentimes, borrowers are looking for the most cost-effective way to be able to buy a property or refinance a property. And as lenders, there's only so much flexibility that I think we have to be able to either pick up or cover some of those costs that are expected during a financial transaction. And so it's important to realize that, like, the evaluation, the title work, that's not done in-house. That's not, owned by these financial institutions. And therefore, we are hiring somebody else to take on that responsibility, and therefore do have to kind of pass on those costs to you, the buyer. So just understand that, again, those are not bank fees that we want to give you, right? Those are just bank fees that we have to comply by for third parties involved. So yeah, let's take a look at the chat room here. Let's see. So we have someone here that reads, we have 2 properties which are currently held in our personal names. And we see that a lot, especially for new investors. Typically, depending on the bank you work with, you can hold anywhere from a minimum of 4 properties in your personal name. Some institutions do allow you to hold more than just 4. And those typically come with very traditional 30-year fixed mortgages. So certainly an option for members to consider. But if you are looking to kind of limit your liability and take that away from your personal name and retitle those properties into an LLC, that's certainly something that you can do. And the question is, are there any issues with doing a quitclaim deed transfer to an LLC? Unsure if the bank, they're unsure whether or not there are certain terms that are allowed within a bank for those types of transitions. They're looking for a cash out refi as soon as possible to put themselves in a better financial position. So for our panelists, what advice you give our, and I guess we should be cautious with the word advice, right? Because we're not attorneys and we're not accountants, so we have to be careful with that word. But what have you seen done in the market when it comes to, personal name properties then being transitioned into a real estate holding company?
Yeah, it looks like from that message, I would assume they're smaller 4 families or below, and they're probably fixed for 30 years with that institution through some sort of government product. With that, then, I would recommend that they would refinance on the commercial side if they're able to. And then once you get the approval from the commercial bank for commercial note, you can quick claim them to an LLC and go from there. Generally, though, commercial banks on commercial notes aren't fixing them for longer 30-year terms or anything like that. So.
Okay. Perfect. And one of the other questions reads, I bought a property about 3 months ago. Can I refinance now or do I have to wait 12 months? And I think that was probably answered during our earlier discussion, depending on the institution that you're working with. Like Arnett mentioned, as long as the appraisal is there, they can go up to 75% loan to value, assuming, again, that the value is there and that the property cash flows. Garnett, do you want to add anything to that, or is that pretty accurate?
No, that is 100% accurate.
Okay. Do you want to take the next one, Jasmine? And please use the chat room, ask as many questions as you want. Just so everyone knows, we will be sending out the contact information for all of our speakers today. Also know that Mike, Jasmine, and myself all work for different banking institutions. Mike at Equitable, Jasmine at Waukesha State Bank, and myself at US Bank. So we're always here as your board members to help you, guide you in the right direction. Sometimes it's not with us, and that's perfectly fine. But in our world, we know a lot of people at different banks that kind of all do the same thing. So we oftentimes know exactly where to guide you for the best option for what you're looking for. Jasmine, any other question that you see on there?
Well, it looks like somebody did have a comment about US Bank. And I think that, you know, maybe you're the best suited, you know, to maybe touch on that. And like Leticia said in the beginning, you know, banks are all adjusting to the market that we're in. And I feel like, you know, maybe your bank adjusts pretty aggressively.
Conservative is the word that we like to use.
Okay. Yeah.
So yes, I mean, if you're one of our customers, you're probably a customer that any other institution would love to bank. The comment does read that, you know, they got a 5-year fixed rate at 2.5, which is an incredible rate, right? Oftentimes we do win with rate. And again, our rates change on a daily basis, so that's not necessarily the rate that everyone would get. But when COVID kind of hit, as conservative of a bank as we are, we did have to take a different approach, right? We had to kind of put ourselves in a position where what would happen if all of a sudden everyone stopped paying rents? And what would happen if retail disappeared? What's going to happen to the income of these properties? Because we're not financing based on loan to value, we're financing based on cash flow. And so typically, like Garnett had mentioned earlier, we take a vacancy discount, right? So 5-10% I think is pretty average for a lot of banking institutions. And we say, you know what, let's just sensitize this even further. What would happen if an additional 25% of that building all of a sudden disappeared? Okay, what's going to happen to this property then? And that's kind of the mentality and the policy that we took into effect last year. Just so everyone knows, we have actually reverted back to our original 5 to 10%. So we are open to lending again on a case-by-case basis. So for that individual that posed a question, I guess my comment to him would be, you know, what kind of prepayment penalty do you have? And do you have the ability, if you don't have a prepayment penalty, which is what we call a full waiver, you may have the opportunity to go back to your banker and say, hey, you know, can you do a proactive renewal and maybe do a little bit of cash out to get some of that money back? Again, it's on a case-by-case basis, but certainly something that I advise that you discuss with your banker, or give me a call and I can, you know, walk you through it and connect with your banker at the bank as well.
Great, thank you. One of the questions.
Jasmine, it's Mike. I know that I'm just going to put out there, and I know that I get asked by a lot of clients, and I think our clients here, the members of the association, they deal a lot with credit bureaus. And I know that I was asked if Brett could touch on credit bureaus a little bit. You know, as landlords, you're dealing with potentially, you know, trying to do as much background check as you can, CCAP, et cetera, et cetera. So I would ask Brett if he could just kind of touch on from an underwriting perspective and give some insight, or maybe if some of the info you had prepared, Brett, on credit bureaus.
Yeah, sure, I can do that. And I do have a slide I can share on that. let's see. So for us, mainly our policy on when we run credits on our commercial borrowers, if you're an existing customer, we'll do a TransUnion only, which is much less hit on your credit score, if any, than the full one. And this is for any new extension of credit, so a cash out refinance or a purchase of a new property. And then if it's a new customer, we'll do a full credit run where it gets your TransUnion, your Equifax, and your Experian one. And then some things that I know I've seen that have surprised borrowers in the past that show up on their credit bureau that they may not necessarily think of is they'll have, if you co-sign for a loan and say it's for one of your children or a family member or something like that, that will also show up on your credit bureau when it's ran by a bank. So that's something to keep in mind that you'll just want to have a quick explanation for, that you may not personally be paying that debt service. So that's something that if they assume you're making that monthly payment, that can be a hit against you that you're not actually paying on a monthly basis. Medical collections can show up on there if they're not paid on time. And then so can missed utility payments if the utility company decides to report that. And then I know Experian they'll show made utility payments for people to kind of boost their score. That's kind of their thing right now, where to get kind of an instant boost to your credit score. And then auto loans, auto leases will also show up on your credit bureau. And then things that won't show up there. So if you have debt, this kind of goes back to the question about moving in a loan on an investment property that's under your name personally to an LLC. So if that debt's under an LLC, that won't show up on your credit bureau. And then I know Mike said that he gets this as a question a lot too. When people are kind of screening tenants, they wonder if they can see evictions and missed rental payments in the past. And those will not show up on credit bureaus that you run of your tenants or on your credit bureau. So the main place where you're going to be able to see if someone has been evicted in the past is going to be in a CCAP. I'll go back to I'll open it up. I see we got some more questions.
Okay. So one of the questions was addressed to Tri-City Bank. Can you kind of reconfirm when it is that you look for a full appraisal versus an evaluation, as you had briefly mentioned earlier today?
Yeah, absolutely. So we require an appraisal for loans over $500,000. If it is under $500,000, we do not require a full appraisal, and we will just do something called an internal evaluation for about $500 or so.
Perfect. And just again, so everyone knows, they wanted your phone number, Yanni. So we will be sending out all of our panelists' contact information along with their email, phone number, address of employer, etc. So everyone should be getting that after our meeting today. Then someone has another question. They recently purchased an investment property using a home equity line of credit. Rate is at 2.25%, so very attractive rate. Is there any reason why they should consider transitioning that from their home equity line of credit to a traditional commercial loan? Garnett, you want to take this one?
I mean, 2.25% is a really good rate. I say no. So.
Well, I think to be a little bit of a devil's advocate there, right? You think about 2.25%, it's pretty attractive, but interest rates are relatively low. So when you increase that by 1/4, 2 or 3/4, depending on the loan size, it may not be that significant of an impact, right? But then you have the ability to pay that home equity line of credit, free that capital, make that available to you, and then utilize that for another investment. So what's the better rate of return? Potentially acquiring another piece of property or saving that extra 1/4 or 2 on the rate. So I think it all depends on your individual plan and your strategy and what you're looking to achieve, right?
And then there was another question. It says, can someone refinance their portfolio of free and clear properties to get funds to pay off leveraged properties?
Yanni,
do you want to?
Sure. So can somebody, absolutely. So if you have some leverage properties, some free and clear properties, you can refinance the whole kit and caboodle in a sense to pay off those leverage ones.
And then there was another one about the docket judgment on the Milwaukee County Courthouse after you've been awarded a money judgment. Our eviction just okay. So you already answered that, Brett, right?
Yeah, I think that's pertaining to whether they're evicting someone or not, or am I correct?
Yeah, it was
With the money
just,
judgment,
yeah.
or if they have
Okay.
owed rents.
Yeah, so again, just to reiterate what Brett said, you know, when you look at someone's credit report, you're not going to find that they were late on a rental payment, that they were evicted. That's not something that's reported on a credit bureau, whether it be Experian, TransUnion, or the other one. That's something that you can search through CCAP. Is that correct, Brett?
Yep. So your best place would be to CCAP them to see if they've actually been taken to court, to see if there's any record of them not paying for their lease, to see if they've had a money judgment against them for that. So that's not going to show up on the credit report. You're right.
Okay, so the other question, which is one that I think we forgot to touch on, is what are terms looking like nowadays, you know, when it comes to the term and the amortization on investment real estate? I know we do typically a 5-year term amortized of up to 25 years. If it's a mixed-use building, depending on the tenant type, it could be 15, 20 years. Garnett, what are you guys doing at Kohler, Yanni at Tri-City?
Yeah, our standard is 5 years, 25-year AM, up to 25 years. So.
Yeah, absolutely. For Tri-City, I'd probably say it varies on asset quality and asset category. Multifamily lending right now, 5 families and up. Depending on age of building, we're going up to 80% at times. Not often at times, but typically we're 75% loan to value, fixed for 5 years. On larger transactions, more encompassing multifamilies, call it $1 million or more, we're going terms up to 7 years, amortized over 25 as well. So it varies though, for sure.
Okay. Jasmine, what are you guys doing at Waukesha State Bank?
Typically, we're going at the 5 on 20. We will go to 25, but we really like to stay at 20 right now.
Brett, Mike, pretty normal at Equitable?
Yeah, I guess I'll take that, you know,
Yeah.
for Brett. But, you know, for me, that's and the bank, again, I'll kind of emulate what Yanni said. So really case-by-case scenario, a lot of factors really come into play, you know, based on that asset class, that asset quality, cash flow coverage, on the property itself, you know, that debt service coverage on the primary resource of repayment, also the global for those individuals, portfolio size, loan size, a lot of things can come into factor there. So, you know, the great thing, you know, we love multifamily so much. So I have a lot of flexibility with our chief credit officer in my ability to propose a structure that I need to do to meet a customer's needs. So 5, 6, 7 year terms, I can, you know, 25-year amort is no problem at all. If I need to flex on that to 27, you know, or 30, I can do that. So again, it's really about working with my customer.
Okay. Yeah, case by case basis, I think a lot of the time, right, Mike? Right. So there's another question in the chat room here. Are any lenders doing blanket loans these days that encompass multiple properties, or is the cross collateration not desired in this environment? Yanni, do you guys do package portfolios at Tri-City Bank?
We are doing portfolio lending like that, encompassing multiple properties. Typically, it's on larger properties or you know, bigger 4s, 5s, 6s, and ups, things like that. Cross collateralization, we're doing plenty of it. We love it. We use it to help cover some of the, you know, down payment deficit. If we don't have that 25% down, we'll cross with something else, gain the remaining equity into the deal to get the deal done. So we're doing it.
Garnett, something you guys are doing at Kohler?
Yep, same here. Yep, that's exactly, we do the exact same thing.
Okay. Brett, Mike,
Yeah.
you guys open to that?
Yeah, we'll do those types of deals as well, where it's across multiple properties.
Perfect. think we have one more here. And this is a little bit of a tough question, I think, just because I think we as lenders all have to be really cautious in quoting rates, especially in a recorded call, right? But what is the 5-year fixed rate for someone with excellent credit? Garnett, you want to start? You guys are seat at Kohler?
Yeah, I mean, that's just such a hard question to answer because honestly, without taking a look at the property, without looking at the cash flow, we can't just quote a rate right off the bat. I mean, but if everything lines up, I mean, they're right now, you're looking at probably 3.5, rate right now.
Yanni, what about you guys at Tri-City?
Yeah, I mean, it all depends on asset category and asset quality. An example, I just did a 40 family in Washington County, and we were low threes on that one, fixed for 5. So, all depends.
Brett, anything you guys want to add?
Yeah, well, one thing to keep in mind when you're looking to get a rate quote is what advance rate or LTV are you looking to get, and then what is your amortization? Because if you're looking for 80% down in a 30 AM, the rate's probably going to be higher than if you're looking to put a 75 or 70% LTV and a 20 and 25 year AM. So that's something to consider. So when you get a quote, you maybe come to terms with where you want to be amortization wise, where you want to be LTV wise, and you probably have a better chance of getting a more accurate rate quote when you ask for those.
Yeah. And I think the other thing that kind of factors in is whether or not you're looking for a prepayment penalty.
Yeah.
Oftentimes, if you're willing to take a waiver, which means that you can pay us off whenever you want without any penalty at all, you might incur a little bit of a higher interest rate just because, you can walk away at any moment in time, where with a prepayment penalty, they kind of have you locked in for that, 5-year time frame or so. So another factor to consider. And I think there was just one more. Can you split properties on one loan to separate loans? So you have a, package deal, one loan, and you're looking to split them up into individual loans. Garnett, you want to take that one? You're the first one.
I gotta think about that one. I don't know. I've never seen it, but it doesn't mean that we wouldn't look at it.
Well, I know, for example, I did a deal where we had 24 properties, 24 units, and our client chose to sell a couple of those properties, and just untangling that to be able to release one piece of property, and making sure that the remaining property supported the loan, and trying to identify if we needed a pay down to make sure we were still within our same parameters, does become a little bit of work for the banker. Of course, we're always going to do it for our clients, but just keep that in mind. If you're thinking long-term hold and you want to package them together, I mean, the higher the loan amount, the lower the interest. Well, obviously you're saving long term, but if you're just waiting for the right offer to come to the table and willing to just kind of sell off that property, you have to think about everything that goes within that transaction, right? You might have to be responsible for updated evaluations to make sure that the value of these properties are still sustainable to carry your loan. So there does, come a lot of liability with that. So just be cautious when you package your portfolios of that. But I don't see a reason why you wouldn't be able to separate them into individual notes if you have different strategy or different plans to do with your properties in the future.
So then it would just trigger an underwriting event, so that you would have to, do credit, pull your credit, and, make sure everything is can support itself. So we are at time right now, so I just want to be respectful of everyone's time this evening. Thank you everyone for joining us, and all your feedback. And like Leticia said, everybody will get the information to reach out to our speakers, so that you can definitely have this one-on-one conversation with them, to see if you're in a good space or not, if you can, make a different move right now with your investment properties or not.
Yep. And I think if I could just add one last thing, I think everyone that's on, the screen right now, that's part of the board or panelists, we're open to, again, have a sit down with you, evaluate your portfolio, maybe help you put a strategy together and guide you in whatever direction that may be. So don't hesitate to call any of us. We're here to help. As board members, that's our job, our responsibility, and to find the right resources for you. So don't hesitate to reach out. Okay. Thank you, everyone. Have a wonderful evening, and be careful with that snowstorm that's coming. Right. Bye-bye.